Welcome back to the deep dive. Today, we're jumping into a really high-stakes situation for the Korean economy. We're focusing on the Korean won, specifically its rapidly falling value. Usually, we're looking for stability, but right now, the signals are pointing towards, well, serious financial instability.
It's a very strange situation. It's almost a textbook case where the market is screaming anxiety.
Yeah.
And yet, some of the underlying numbers, they seem to tell a completely different story.
So what are we actually tracking here?
We're tracking a rapid increase in the exchange rate. That's the technical way of saying the value of the won, the KRW, is in a sharp decline. Some reports are even calling it an outright plunge.
And we should be clear, we're not talking about minor corrections. Recent quotes have the exchange rate floating around 4,471 to the US dollar. That's a high number on its own, but the historical context, that's what makes it feel alarming.
Precisely. The won's value right now is actually lower than its average during, recent periods of intense political stress. And to really quantify this, we look at the Bank for International Settlements, the BIS.
Okay, the BIS, what are they showing?
Their key metric, the real effective exchange rate, it shows that KRW's value is at its lowest point since the last major foreign exchange crisis.
Lowest point since the last crisis. That's a massive statement.
It is.
And that really sets up the core mission for this deep dive, which is to understand this paradox. Why is the won falling when the economy is, by some measures, signaling health? We've got a strong stock market, a current account surplus. These things should logically make the won stronger. Why is the basic economics textbook wrong right now?
Well, the textbook isn't totally wrong. It's more that the architecture of the economy has fundamentally changed. The problem is what happens to the dollars after they come into the country. We're in the middle of a major economic paradigm shift.
Okay, let's unpack that. I mean, the basic principle is pretty simple, right? Korea exports more than it imports. That creates a surplus. Dollars flow in, and the increased supply of dollars should make the won stronger.
That's the theory. But in practice, the domestic foreign exchange market is running dry. The dollars are coming in through exports, yes, but then they're immediately shipped back out. Or they just bypass the domestic system altogether.
So the profit is there on paper, but the actual cash, the currency, we need to stabilize things.
Yeah.
It's just not here.
Exactly. It's scarce.
It's like we're on a structural treadmill, we earn the dollars, and then poof, they're gone. So what are the two big forces pulling that capital straight back out?
The first one is a pretty modern phenomenon tied to global financial access. It's the aggressive buying of U.S. stocks by our own retail investors.
Wow.
The group people call the Western investing ants.
Yeah.
When they buy shares in Tesla or Microsoft, they have to convert their won into dollars, and those dollars leave Korea to buy assets abroad.
That's a fascinating dynamic. So our own domestic enthusiasm for higher returns is actually creating capital outflow. It's a sign of financial freedom, I guess, but it's also actively destabilizing our currency.
It is. The dollars that we earn from the current account surplus are being funneled directly into international markets, completely bypassing domestic reinvestment.
And what about the second engine? You mentioned corporate investment. That's usually a good sign, a sign of maturity.
It is, but the scale is what's different now. It's enormous. Korean corporations are massively increasing their overseas direct investments. This is for strategic expansion, building factories, buying firms. And frankly, sometimes it's due to geopolitical pressures. When a huge company decides to invest billions abroad, they have to move massive amounts of dollars out of Korea. And that drains liquidity.
So the takeaway isn't that we're not earning enough. It's that the dollars we earn aren't circulating here at home. This scarcity pushes the dollar's value up and the won's value down.
Precisely. And this leads right into a crisis of confidence in the authorities. The government and the central bank, they recently tried what's called verbal intervention.
Basically just talking up the currency, right? Saying they won't tolerate the decline.
Yes, and the market completely ignored them.
It didn't work.
Not at all. The won kept falling. And that just feeds the public fear that the authorities have, lost their ability to manage the exchange rate.
But let's zoom out. Are we fundamentally weak? When the exchange rate drops like this, people get flashbacks to past financial crises. Are we really that vulnerable?
And that is the absolute critical distinction to make. We are not. While the management issue is a serious worry, the economic fundamentals are so much more robust than they were 20 years ago. Back then, a falling currency could mean national bankruptcy.
Okay, so what's the one data point that proves that underlying strength?
You have to look at Korea's net overseas bonds. This is the net difference between what foreign countries owe us and what we owe the world. That figure. It's at 1.1 trillion US
A
dollars.
trillion, wow.
Now compare that to our foreign exchange reserves, which are around 428 billion. We have more than double our reserves in net assets held abroad. The country is not insolvent, the money is just. It's located outside our domestic banking system.
So if the capital is technically ours, what's stopping us from bringing that $1 trillion back home to stabilize the won right now?
The barrier is incentive
Hmm.
and policy. You can't just force a retail investor to sell their Apple stock, and you can't force a corporation to abandon a factory overseas. Repatriation needs a powerful incentive, like much higher interest rates here, or a really convincing signal that the won is about to get much stronger. The problem isn't solvency, it's a structural liquidity problem, and a psychological one.
And that brings us right to the next battlefield, interest rates. The Bank of Korea has a big decision coming up. Every central bank has to balance growth against defending its currency. What's the priority now?
It has to be currency defense,
Okay.
FX defense as they call it. The analysis we're looking at argues very strongly against a rate cut, even though that's politically appealing. In fact, it suggests we need to signal a potential rate hike.
A hike. Why is that so urgent? I'm guessing it comes down to the rate difference of the U.S.
Absolutely. The U.S. interest rate is potentially heading to 4%. Ours is at 2.5%. That 1.5 percentage point gap is massive, and it's sucking capital out.
And there's some incredible historical context here, isn't there?
There is. It's fascinating. For 4 years now, since 2022, Korea's interest rate has been consistently lower than the U.S. rate. If you look at the entire 80-year financial history of the Korean economy, and take out these last 4 years, our rate was always higher than the U.S. rate. This situation we're in now is a complete historical anomaly.
That's a phenomenal point. So the system is, from a historical view, broken. And investors see that anomaly clearly. Why keep your money in won when you get a higher return in the U.S. and you also think the won is going to keep falling?
You wouldn't. There's a double incentive to leave. This gap actively encourages capital flight, and it encourages bets against the won. It becomes a self-fulfilling prophecy. The authorities have to move past this idea that rate cuts are always good and prioritize restoring confidence.
But signaling a rate hike, wouldn't that be political suicide? With all the household debt and the need for growth.
It's a massive dilemma, no doubt. But the cost of doing nothing, of letting the currency devalue, that leads to higher import costs, higher inflation, and eventually a much bigger, more painful hike down the road. The market needs a clear signal that the bank will defend the currency at all costs.
Let's broaden the view. How are other markets reacting to all this anxiety and currency weakness? The KOSPI, our stock market, saw some pretty big swings recently.
It did. The KOSPI was pushing near that 4,000 mark and then had a sharp correction. That volatility is a direct symptom of this uncertainty. We saw over 10 trillion won pulled out of investment deposits in just 2 weeks.
Wow, so cash is just sitting on the sideline.
Exactly, waiting for a clear signal from the currency market and the central bank.
What specifically triggered that correction in stocks?
2 main fears. First, worries about a potential AI bubble. If that growth is overhyped, then demand for semiconductors, our export engine, could fall off a cliff. Second, the ongoing fear that U.S. rate cuts are delayed. That tightens global liquidity and raises the risk of a broader market crash.
Okay, so high uncertainty means everyone runs to cash. Let's pivot now to housing. It's just as volatile and a huge social issue, especially in Seoul. How does the currency problem connect to the housing dilemma?
It connects through regulation and, maybe more importantly, through trust. The housing market is defined by this strange irony. There's massive demand from young people who believe prices will only go up, so they feel this pressure to buy now with maximum debt.
Right.
But that demand is being choked by lending restrictions, which block access for those same people.
I saw a statistic about this, that 30-somethings in Seoul, the most economically active group, actually have the highest rate of non-home ownership in history.
They want in, but they're blocked by price and by regulations. And that's made worse by a fear of missing out. Young people feel pressured to rush because they think if they wait, they'll be priced out forever. That urgency, which is born from a distrust in policy, is really destabilizing.
So the long-term solution isn't just about more cheap money. It's about breaking that buy now or lose forever cycle.
Exactly. We need to modernize the whole housing finance system to take that pressure off. We need options like long-term mortgages, the kind they talk about globally, 40, 50, maybe even 100-year mortgages. That way, younger generations feel guaranteed that they won't be punished for taking their time.
And that gets to the heart of it, which is the erosion of public trust. The government puts in these rules saying they're paving the way for cheaper homes later. But if that promise doesn't come true, faith in the policy just evaporates.
The effectiveness of any regulation, Whether it's for housing or finance, it all hinges on public trust. If the government fails to deliver on that promise of affordability, people will just find ways around the rules. Or, in the case of the one, they'll pull their capital out of the country.
Which brings us full circle. The weakness in the one, the volatility in the KSPI, the pressure in the housing market, it all seems rooted in this structural shift where our profits aren't recirculating, and it's all fueled by a loss of confidence.
That's the core takeaway. Korea's economic fundamentals are strong. That 1.1 trillion in overseas bonds proves it. But stability demands confidence. The authorities have to send a powerful, convincing signal that the KRW decline is over and a recovery is coming. Without that signal, capital will keep leaving no matter how many dollars we earn.
That signal is key. That confidence is needed everywhere, from currency defense to housing rules. So let me leave you, the listener, with this final thought. If the authorities fail to deliver on the promise that today's regulations will lead to cheaper access tomorrow, what poses the greatest long-term risk to the Korean economy? Is it the capital flight we're seeing, or is it the irreversible erosion of public faith in policy itself?
That question gets right to the true vulnerability. It's an issue of psychology, not just math.
A powerful thought to consider. That's it for this week's Deep Dive. We'll see you next time.